All right, let's jump right into this explainer. We're looking at a massive paradox surrounding IREN today. I mean, this stock has seen an incredible surge recently, grabbing the attention of major institutions and retail traders alike. But it's still weighed down by lingering unprofitability. So we're going to unpack the big question. Is this a brilliant AI cloud bet or just another tech bubble waiting to pop? And this setup right here brilliantly illustrates the tension we're dealing with. On one hand, you've got a stock that's up 50% from its July lows, right? And that's bolstered by massive tech partnerships with absolute giants like Microsoft and NVIDIA. But at the exact same time, it's still down 40% from its absolute peak, and the company remains completely unprofitable. It's a really stark contrast between market excitement and fundamental reality. To unpack this impartially, here is our roadmap. We'll go from Bitcoin to the AI cloud, explore the bull case, understand the bear case, check out the upcoming earnings catalyst, and finally, assess the final verdict. Part 1, From Bitcoin to AI Cloud, the 18-month pit-in. Okay, so we have to start by understanding exactly what IRN, which you might remember as Iris Energy, is actually building. Over the last 18 months, they've aggressively pivoted away from being a pure Bitcoin miner. Now they're focusing almost entirely on the future, building highly specialized AI data centers. They're aiming to scale up operations similarly to infrastructure heavyweights like CoreWeave or Oracle, essentially transforming their legacy footprint into high-performance computing hubs. The sheer scale of their operations is frankly staggering, especially when you look at their Childress, Texas facility. They are building 4 massive 50-megawatt liquid-cooled AI data centers. And the first phase, dubbed Horizon 1, isn't just a blueprint, it's live, and it's already delivered to Microsoft. We are talking about a production-scale deployment with a literal $9.7 billion contract attached to it. Add in a $3.4 billion NVIDIA deal for GPUs, plus achieving that super rare exemplar cloud status. Yeah, they are playing in the absolute highest tier of tech infrastructure. Part 2, Exploring the bull case. Why all the optimism? Let's look at the financials to see exactly how this builds a massive bull case for investors. Bulls absolutely love the revenue visibility here. When you look at their crazy $4 billion annualized revenue target, over 85% of that demand is already contracted. That means it is locked in by hyperscalers, the massive cloud providers like AWS or Azure, leaving only 15% as uncontracted demand. That gives them an incredible foundational floor for their future cash flows. So the really crucial point here is that their AI cloud revenue isn't just some promise written on a whiteboard. It's translating into real, explosive growth right now. I mean, their AI cloud revenue actually jumped a staggering 94% sequentially in just the last quarter, hitting $33.6 million. And as more of those NVIDIA GPUs come online, bulls fully expect this number to just scale rapidly. Furthermore, they've secured incredibly cheap money to fund all this growth. They're currently sitting on a massive war chest of roughly $2.6 billion in cash. Plus, they raised another $2.6 billion via convertible notes at a jaw-dropping 1% interest rate. This is essentially super cheap debt that can turn into stock later, giving them the financial firepower to fund this extremely capital-intensive expansion without having to immediately dilute their shareholders. And hey, it isn't just retail investors getting excited. Wall Street is actively buying into this story too. Just look at the conviction here. The average price target sits at $81.73. That is nearly double where the stock is currently trading. Firms like B. Riley have their target all the way up at $96, and H.C. Wainwright is right behind them at $90. The institutional conviction on the bullish side is absolutely undeniable. Part 3, Understanding the bear case, the red flags, and the risks. Now, however much the bulls love it, we've got to impartially weigh the scales and look at the very real concerns dragging the stock down. Let's start with valuation, which bears argue is significantly stretched right now. IREN is trading at a forward price-to-sales ratio of 6.5 times. That means investors are paying $6.50 for every single dollar of expected revenue. Compare that to the industry average of just 3 times. Basically, the market is already pricing in near-perfect execution. If there's even a slight hiccup in their data center rollout, the stock has a long way to fall just to get back to an average industry valuation. And here is the harshest reality. Despite those massive contracts and the killer revenue growth, they are still losing money. Last quarter, they posted a net loss of nearly $248 million. Now, sure, massive upfront capital expenditure is pretty normal for a growing infrastructure company, but at this kind of premium valuation, investors are rightfully demanding a much clearer path to actual profitability. Adding to all that pressure are multiple friction points during this huge corporate transition. First off, their legacy Bitcoin revenue dropped 33.6% sequentially as they shifted focus to AI, kind of leaving this awkward gap where neither business is firing on all cylinders just yet. Second, they're facing intense AI cloud competition from the likes of Applied Digital, CoreWeave, and TeraWulf, who are all racing to build the exact same capacity. And finally, a massive 26% of their shares are currently sold short. Think about that. That means a quarter of the market is actively betting that this company is going to stumble. Part 4, the upcoming earnings catalyst, the August 27th tiebreaker. So how will the market finally decide between these two wildly extreme viewpoints? Well, the upcoming August 27th earnings report is the ultimate tiebreaker. To see who wins out, the bulls or the bears, we'll need to closely scrutinize 3 specific metrics. Number 1, AI cloud revenue growth. Did that massive 94% jump accelerate, or is it starting to slow down? Number 2, gross margins. Are these huge multi-billion-dollar contracts actually profitable, or are they just heavy on revenue? And number 3, guidance. Are the timelines for their Horizon 2, 3, and 4 deployments actually still on track? Understanding the mechanics of that 26% short interest we just talked about is absolutely critical here. It creates a total powder keg scenario for earnings. A strong report, like a solid beat on expectations, could trigger a violent short squeeze upwards, as short sellers are forced to frantically buy back stock to cover their losing bets. Conversely, an earnings miss, well, that could validate the bears and send the stock plummeting straight back down to the $30 to $35 range. The stakes literally could not be higher. Part 5. Assessing the final verdict and how to play it. Let's organize all this data and look at the final takeaways for the different types of market watchers out there. Depending on your strategy, the takeaway totally changes. If you're the bullish archetype, you likely see a high-conviction opportunity to multiply your investment, relying heavily on those locked-in contracts and Tier 1 partners like Microsoft and NVIDIA. If you fall into the cautious camp, you might prefer to wait for earnings, noting that valuations are incredibly rich and the execution risk is just super high. And for the traders out there, you're looking at high volatility, knowing full well that the 26% short interest offers the potential for incredibly sharp, profitable moves in either direction. Regardless of your stance, IREN remains a total story stock that is currently priced for perfection. So to wrap up our explainer today, we have to ask the ultimate question. Will the upcoming numbers prove they're a true AI powerhouse capable of fulfilling these massive contracts, or is this transition simply overextended on hype? Are you buying the future of infrastructure or stepping right into a highly priced trap? Consider which side of the table you're sitting on as we head into their next report.